FY19 was a dream run for gold financing companies and the strength continued right till the end of FY20. The markets too rewarded the sector, bellwether Muthoot Finance. In our Ideas for Profit today, I'll discuss if Muthoot Finance can really continue to shine after the recent run-up that has already been seen. Well, Muthoot ended FY20 on a strong note. The consolidated after-tax profit for the full year grew by 51%. Now, close to 95% of the profit was contributed by standalone Muthoot Finance, predominantly the gold loan. Now, the improvement in asset quality leading to moderation in the credit costs as well, strong asset growth, and the improvement in the interest margins on the back of lower funding cost aided the show this time. Consolidated group loan assets grew by over 22%, driven mostly by the gold loan businesses. However, a large part of the growth may also be attributed to the steep rally in the gold prices. Now, the company is also seeing traction in gold demand as the liquidity crunch due to the lockdown might also increase the propensity to monetize gold. Now, we would also be watchful about the tonnage growth going forward from here on. Gold lending is perhaps the only safe haven amid the turmoil caused by the pandemic. The company has seen an improvement in asset quality in the quarter under review, that is Q4 of FY20. Now, the proportion of bad assets has also declined to 2.16% from 2.54% in the previous quarter. For instance, as against the gold loan portfolio of 407 billion rupees as on March of 2020, the market price of the underlying gold was 696 billion rupees, providing adequate margin of safety. The company did experience some disruption as branches were mostly shut in April, but activity is now coming back fast and business is now 70% back to the pre-COVID level. Now, the company is well funded so far and has created liquidity buffer by borrowing from the overseas markets as well. It has not asked for any moratorium from its lenders also, which is a positive. Now, to achieve this targeted double-digit growth in FY20, it would definitely require 6,000 crore rupees of additional funding, and this remains key to its near-term growth journey as well going forward. Now, the company has adequate capital cushion with a capital adequacy ratio at 25.47%. Now, the share of subsidiaries in the gross loan assets was 11% at the end of FY20. However, their share in PAT was just 4.7%. The final quarter of FY20 was weak for most of the subsidiaries. Belstar Microfinance has created a small provision for COVID-19 and the collection efficiency that had dropped to 17% in April is now back at 65%. However, we remain watchful. Muthoot HomeFin is likely to see a step up in the provision in the coming quarter, and over 1/3 of its borrowers have already availed of the moratorium. Now, being a thin margin business, we do remain cautious about its prospects as well. The core business appears to be in fine fettle and the company will have access to the requisite funding as well, and we do not rule out the hiccups in the performance of the subsidiaries going forward. Now, higher share of gold loan makes it relatively more insulated when you compare it with the listed peers. Muthoot Finance has already rallied by 132% in the past 3 months, as against 35% surge in the Nifty. The steep rally in the recent times also captures some of the optimism. Muthoot Finance, however, remains an island of relative safety, and we would definitely recommend accumulation as and when you see stock market correction.